Okay, the non-farm payroll report came out last Friday at 525,000. It's very strong, double the consensus forecast. And the net upward revision is 28,000, and that was also strong. And unemployment rate fell from last month 3.6% to 3.5% in July, and that was actually the lowest level since 1965. And average hourly earnings rose 0.5%. In July, and that's above market expectation as well. And also the June number, June average hourly earning also revised up 0.1 percentage point to 0.44%. And this strong hourly earnings data actually rebuts the inflation thesis, and that actually is point to continuous inflation pressure. And now the market, I mean, the bond yield up, the 2-year up 18 basis point, 10-year up 10 basis point, and the front month, the money market curve actually all up more than 15 to 20 basis points. So the market basically now is pricing in quite a high probability for a 75 basis point hike in September, and that was a big change from before the meeting. And then, of course, it's the important things. We have the CPI number from the US this Wednesday. So I think that would be very important. At the moment, the market expecting it to be slightly coming down. The headline will be down to 8.7% from last time's 9.1%. And the core will also, however, will still be 6.1%. And that actually is higher than last time, 5.9%. I mean, that's the expectation, but I mean, that will be very important to watch that on Wednesday. And other thing, in China over the weekend, China's exports were strong. It grew 18% year on year in July, and in US dollar term, China's export is a grow 18%, and then it's actually quite across the board, and it grew quite well with Japan, ASEAN, and the EU. And the only thing is that the growth, export growth to the US slowed down a bit. And so we are talking about the stock, the bond market sold off, and then because of the non-farm payroll, and the dollar yen is the most sensitive to interest rate differential, and dollar yen up 1.6% and to 135. And the stock market, however, was in the US, it was pretty resilient, and mainly because I think is I think so far the earnings, S&P has reported earning is about 431 company already reported earning as of Friday, and 53% of them report earning beating market consensus by more than one standard deviation. So I mean, historically it's below 50%. So it's better than fear earnings. Maybe the earning forecasts were a little bit too pessimistic. So it's so that actually has been supporting the stock market. And so I think, yeah, but I mean, we think that is a given. The market is pricing already some rate cut next year. I think we think that the market will be disappointed, and so. So that will also later on will put additional pressure on the stock market. Stock market now, the S&P PE traded 18 times, and so it's at the beginning of the year it's at 22 times, and it came down to 15 times when bond yield went up, and now it's bounced back to 18 times when bond yield actually retraced over the last few weeks. And now if bond yield go up again, maybe there's also some pressure on the PE again, and that will put additional pressure on the stock market again. So I think that are the key things. Basically, we'll be watching CPI this week, and in China they also have some credit data coming out during the week, but maybe that will be less important. And also we will be monitoring also what's happening in the in any further reaction from China and to the to Penosi's visit. But at the moment, seems the market has already put it onto to the best seat, and I think that is is pretty much as expected, the reaction, and it's not, at least for the time being, is not going to escalate. I think that's all for me. And sorry for the technical hiccup earlier. And yeah, we will test it more thoroughly next time and make sure that will not happen again. Thank you.